There's a fidelity study nobody can quite find a copy of, but everyone in finance has heard about it. The story goes like this. Fidelity pulled the data on their best performing accounts over a decade. They wanted to know what the winners were doing. The winners weren't the day traders. They weren't the spreadsheet guys. They weren't the guys who read every earnings report. The winners were the people who had died, and the people who had completely forgotten the accounts existed. The study might be apocryphal, the lesson isn't. The single most expensive thing the average investor does is try. My name is Nick, and on this channel, we break down the math behind the money decisions nobody's actually doing, right? Meet Sarah. She's 32, makes $78,000 a year. Last Tuesday at 11 p.m., she Googled how to build wealth and closed the tab feeling worse than when she opened it. By the end of this video, Sarah is going to be a millionaire. And she's going to do it by working less on her money, not more. Today, I'm walking you through 10 lazy money habits that quietly build wealth. Almost nobody is using them. Habit 1, auto-escalate your 401k. Let's start with the toggle hiding in plain sight. You've logged into your 401,000 maybe twice in the last 5 years. Both times you closed the tab without changing anything. There's a switch buried 3 menus deep that would have made $700,000 called auto-escalation. You click it once, it bumps your contribution by 1% every January. You're done forever. Sarah turned this on at 32. She started at 4% of her income. 11 years later, she was contributing 15%. She never made a single deliberate decision to increase her savings. The toggle did it for her. Here's the math. A 3-year-old earning $70,000. Who contributes 4% to her for $101,000 and never touches it again retires with about $36,000. The same person who flips the auto. Escalate switch retires with around $1.05 million. That's a $700,000 swing for one click. Vanguard's data shows only about 70% of plans with auto-enrollment also have auto-escalation. And even fewer workers turn it on. Why? Because nobody told them. The default is set to broke. Most people never change the default. You won't feel the 1% bump. It comes out before your paycheck hits. You'd never notice the money was missing. But in 30 years, your retirement accounts will have it too. The Stealth IRA, HSA. Now, while we're on the topic of accounts you're using completely wrong, let me introduce you to the most powerful retirement vehicle in the U.S. tax code. I'll bet you $1 your HR department never explained it correctly. Right now, if you have an HSA, you're probably spending the money the second it hits the account. Co-pays, prescription pickups, the occasional pair of glasses. Stop. Sarah has a coworker named Mike. Same job, same income. Mike's been doing exactly what I just described for 30 years. Sarah did something different. She maxed her HSA every year. $4,400 if you're single, $8,750 if you have a family. She invested the entire balance in index funds in every major HSA provider lets you do this. Then she paid all her medical bills out of pocket and stuffed every receipt into a folder on Google Drive. Why? Because there is no statute of limitations on HSA reimbursement. You can pay for a $4,000 medical procedure today. Save the receipt. Let the money in your HSA grow tax-free for 30 years. and then reimburse yourself into 106. The IRS literally cannot stop you. It's the only triple tax advantaged account in America. Tax deductible going in, tax-free growth, tax-free coming out. There is nothing else like it. Sarah and Mike are both 60 to now. Mike's HSA has $4,000 in it. Sarah's has $890,000. All of it tax-free, according to the Employee Benefit Research Institute. Only 15% of HSA holders actually invest the balance. The other 85% are Mike. They're sitting on top of the most powerful retirement account ever invented and using it like a debit card. Habit 3, the do-nothing portfolio. Quick rehook. The next one sounds insulting at first. Stay with me. Here's the strategy. You buy one fund, a target date, retirement fund, or a total market index fund, or a simple 3-fund portfolio. You set up automatic contributions, and then you do not log into the account again for 30 years. That's it. That's the strategy. It beats almost everyone. There's a study called the Dow Quantitative Analysis of Investor Behavior runs every year. In 2024, the S&P 500 returned 25%, one of its best years ever. The average equity fund investor earned 16.5%. They underperformed the market they were literally invested in by 8.5 percentage points in a single year. How? Because they panicked. They sold during dips. They jumped in late. They chased fads. They switched funds. They tinkered. The market did all the work. Humans got in the way. Over the last 20 years, the average investor underperformed the S&P 500 by 1.1 percentage points every year. Doesn't sound like much. Component over a career. It's the difference between $1 million and $1.2 million. 22% of your retirement evaporated just because you couldn't stop touching the thing. Sarah's plan is one fund. She set it up at 32. She has not logged in since. She tells me she sometimes can't remember her password. The lazy portfolio isn't a compromise. It's not good enough. It's mathematically the optimal strategy for 99% of human beings, because it removes the only variable that consistently destroys returns. You have it for asset location. If you've heard of asset allocation, congratulations. You've absorbed about 20 years of personal finance content. There's a cousin of that idea almost nobody talks about. It's called asset location. Asset allocation is what you own. Stocks, bonds, real estate. Asset location is which accounts you keep them in. Turns out this matters a lot. Here's the rule. Tax inefficient stuff, bonds, rights, anything that spits out a lot of interest or dividends goes inside your 401k or traditional IRA, sheltered from taxes. Tax-efficient stuff, broad index funds, ETFs that barely pay dividends, goes in your Roth IRA where it grows tax-free forever. And your taxable brokerage where dividends and gains get the lower 15% rate. That's the strategy. Make the decision once, never touch it again. Vanguard ran the numbers on a $1 million portfolio over 30 years. Optimal asset location saves you around $74,000 in taxes you'd otherwise hand the federal government. The Vanguard Advisor Alpha Framework says it's worth up to 3/4 of a percentage point a year. That's the kind of thing financial advisors charge 1% a year to do for you. Most people hold mirror image portfolios, same 7,030 mix in every account. Because nobody told them the IRS taxes the same dollar differently depending on which drawer it's sitting in. Real example, that high-yield bond fund spitting out 5% interest in your taxable account. You're handing the IRS 22% of that yield every April. Same fund inside your 401k zero. Same dollars, same fund, different drawer. You'll spend an hour on this. Then you're done. The IRS code does the rest. Habit 5. T. Belil Auto Roll. Halfway check-in. Everything we've covered has been about investing lazily. Let's talk about saving lazily because there is a generational scam happening in American banking. And most people don't know they're the victim. You probably have an emergency fund sitting at Chase or Bank of America right now earning 0.01%. It's been there for years. Every month your bank makes more on your money than you do. The FDIC's national average savings rate is 0.38%. The U.S. government is currently paying about 3.7% on a 26-week Treasury bill. Same risk profile on 10 times the yield. Here's how Sarah handles it. She opened a free account at treasurydirect.gov, bought a 26-weekly bill, checked one box that said auto-rinvest. Every 6 months, the government takes the money, rolls it into a new bill, pays her the next round of interest forever without her input. On $50,000 in emergency cash, the difference between Bank of America's zero, 40% and a T-bill at 3.7% is $1,650 a year for zero work. USD bill interest is also exempt from state income tax. So, if you live in California or New York, the math is even better. IBANs work similarly, currently paying for 0.03% backed by the U.S. government. State tax-free, designed to beat inflation automatically. If your emergency fund is sitting at a big bank earning nothing, you are not saving. You are tipping a multi-billion-dollar institution for the privilege of holding your cash. The default is set to broke. Change the default. Habit 6, the 5 to 9 to Roth roll over. If you're still here, you're already in the top 5% of people who will actually do something with this. The next 4 habits are where the real money hides. This one is so new, your accountant might not know about it yet. In December 2022, Congress quietly passed a law called Secure to Point Zero. Buried inside was a provision that became active in January 2024. It solves the biggest problem with 529 college savings accounts. What happens if your kid doesn't use all the money? For decades, the answer was pay a 10% penalty plus taxes to get it out. So parents underfunded 529s out of fear. Now you can roll up to $35,000 of leftover 529 money directly into the kid's Roth IRA. No penalty, no taxes, limited to the annual Roth IRA contribution amount each year. Here's why this is insane. Roth IRAs have income limits. If your kid grows up to be a software engineer making $100,000, she's locked out of contributing to a Roth. But this rollover, no income limit. None. You can fund a Roth IRA for a high-earning adult child who otherwise couldn't touch one. Run the numbers. $35,000 dropped into a 2-year-old's Roth IRA. Never another contribution. 7% returns until she's 65. That account becomes $617,000 tax-free forever. You filled out one form. The kid will retire with most of $1 million. The 529 has to be 15 years old. The contributions you're rolling have to be 5 years old. So, if you have young kids and number 529 yet, opening one just to start the 15-year clock might be the highest leverage thing you do this year, even with $50 in it. Habit 7, direct indexing. Now, we get into the stuff that used to be reserved for rich people, and isn't anymore. Here's how a normal index fund works. You buy VO, you own all 500 companies in the S&P 500 in one neat bundle. End of story. Here's how direct indexing works. The platform buys all 500 individual stocks for you. You still own the S&P 500. Same exposure. But now there's a little robot watching every single position. Whenever any individual stock dips below what you paid for it, the robot sells it immediately, buys a similar stock to keep your exposure intact, and banks the loss. That loss can offset capital gains elsewhere in your life. A stock sale, the sale of a business, a real estate deal, or up to $3,000 of your regular income every single year. You do nothing. The robot does everything. Schwab, Fidelity, Wealthfront, Vanguard, they all offer this now. Low fees, no real minimums. 5 years ago, you needed $1 million to access this. Today, you need maybe $5,000. Vanguards. Research says direct indexing adds up to 1 to 2 percentage points of after-tax return per year compared to a regular ETF on a $100,000 taxable account growing at 8% with $20,000 a year in contributions over 30 years. That 1 point edge becomes around a $350,000 difference in ending wealth for less effort than buying a regular index fund because the robot is doing the part you weren't going to do anyway. Habit 8, the mega backdoor Roth rehook. If you work in a company with a halfway decent 401k, this next one might be the most powerful tax move you'll ever make. There's roughly a 50% chance you have access to it. There's a near 100% chance nobody told you. It's called the Mega Backdoor Roth. Bear with the name. The strategy is the point. Here's the deal. The IRS limits your 401k employee contributions to $24,500 in 2026. Most people stop there. They shouldn't. The actual ceiling on your 401k is $72,000. Your $24. $500 plus your employer's match plus a bucket nobody told you about. That bucket is the trick. That bucket can be filled with what's called after-tax contributions, and in plans that allow it. Those after-tax dollars get automatically converted into a Roth IRA every paycheck on autopilot. That's an extra $30,000 to $47. Zero per year of Roth contributions on top of what you're already doing compared to the normal $7. 500 Roth IRA limit. You've just multiplied your Roth space by 6. Max this for 20 years at 8% returns. You build an extra $1.8 million of completely tax-free retirement money. None of it ever taxed again, ever. Microsoft, Google, Meta, Amazon, Apple, Nvidia. They all offer it. The Plan Sponsor Council estimates roughly half of all large 401k plans support it. Most workers at those companies have no idea. Call HR on Monday, ask them, does our plan allow after-tax contributions? And either in-plan Roth conversions or in-service withdrawals? If they say yes, you just unlocked the most powerful retirement tool in the country. Probably none of your coworkers are using it. Habit 9, the Roth conversion ladder. This next one only matters if your income drops in any given year. Could be retirement, could be a sabbatical, could be a layoff, could be parental leave, could be the year between jobs, could be a year you decide to take 3 months off and travel. Whenever your income drops, the IRS offers you a quiet little gift almost nobody picks it up. It's called a Roth conversion ladder. In any low-income year, you convert a chunk of your traditional 401k or IRA into a Roth IRA. You pay tax at your now temporarily low rate, maybe 12%, maybe 0% if you're between jobs. Then, after a 5-year wait, that converted money becomes withdrawable, tax-free, penalty-free at any age. Real example. A married couple in the 24% bracket retires at 63 with $2 million in a traditional IRA. They convert $94,000 a year. You know, the top of the 12% bracket for 10 years. They pay 12% on conversions instead of the 22 to 24% they would have paid on required minimum distributions later. Lifetime tax savings $160,000 to $200,000. The form takes 5 minutes at Vanguard or Fidelity once a year. That's the strategy. The reason most Americans don't know about this is that mainstream financial advice assumes you'll work full-time at the same income from 22 to 65 and then retire. Real life doesn't look like that. Layoffs happen, kids happen, burnout happens. Every single one of those is a tax-saving opportunity if you know how to use it. Habit 10, TO, Pod Beneficiary Designations. Last one. I promise this is the easiest item on the entire list. You can do it tonight in pajamas in about 30 minutes. It will save your family somewhere between $30,000 and $130,000. Right now, your accounts probably list a beneficiary you set up a decade ago and haven't looked at since. There's a real chance it's next or a dead grandparent or nobody at all. Here's the thing. Nobody tells you about probate. When you die, if your assets aren't structured correctly, your family doesn't get the money right away. The court does for a long time. The American Bar Association estimates probate takes 16 months on average. It consumes 3 to 8% of the estate in legal and court fees. On a $1 million estate, that's $30,000 to $80,000 going to attorneys instead of your kids. In California, the statutory probate fee on a $1 million estate is around $46,000. Now, here's the fix. Every brokerage account, every bank account, every retirement account, and, in 30 states, your house. 2. They can all have what's called a transfer on death or payable on death designation. You log in, you add the names, you log